Good, bad, or just okay for small business owners? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, every year, sometimes twice a year, the budget is a big kind of event that in the office we all get together, watch TV, get some food in, heckle and cheer. And this year was no different. And actually this year, there was quite a lot of things to get involved with. Now, as always on these videos, I'm talking about the small business outcomes of these things. So if you don't know much about the budget, maybe this is your first time you're really caring about what's going on. You know, the Chancellor, the first female Chancellor ever, gets up, gives us some plans for what's happening in the UK and their plans. And of course, those things include tax and other measures which affect small businesses. So in this video, I want to talk to you about the small business outcomes from this budget. So there's going to be things I don't mention in here. You know, I'm not going to talk about fuel duty or anything like that because it's just not in the kind of wheelhouse of what I think is important to talk about right now. But I've got to talk about the key things that came out of there that really you need to know about and be thinking about, particularly if you're an employer, as we're going to discuss. Now, I think it's been an odd one. I did some local radio stuff and we've produced content for the podcast and the blog and here on YouTube. And one of the things people want to know is it good or is it bad? And actually that one I think is going to come down to where you are. So I think if we start there, I know sometimes with the summary it's nice to finish somewhere on that, but I want to start there. Is it good, bad, or like okay? Do we not care? And I think talking to clients and other business owners and just looking detailed at the budget, I think it depends on where you are. Now, if you're a small business employer, it's pretty horrendous. And in fact, this black shirt might be quite appropriate because you should feel a little bit probably in mourning about some of the things we're going to talk about. But there's a real challenge there for small business employers, and we're going to talk about that. I think if you're self-employed, not a limited company, just self-employed individual, not much has changed. And sometimes no change in the business world is good. Gives you some certainty about what's going on. You can make some financial decisions. And I think if you're a limited company on your own, you might also think about that as well. If you're not an employer, but say you're a freelancer with a limited company, there's actually some quite good news in terms of stability that came out in that budget. So we're going to dig into that a little bit more, but that's where we are. And of course, there's niche things. I think if you've got a very expensive farm, there's quite a lot to talk about that at the moment. You might have some problems. There's issues where if you're going to sell your business, you would be in a worse place now than you would have been if you'd sold it on the evening of the 30th of October. You know, like there's these niche cases, but I think in overall summary, that's where we're sitting at the moment. So I think it's a good time then to dig into some of the measures. Before I do, if you do like these videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So then what happened in the budget? Well, firstly, of course, if you had some sort of bingo card, you would have absolutely had this on there. And there was mention of this £22 billion black hole. Now, certainly, depending where you are on the political divide and having dug deep into the numbers, you can argue whether that ever existed or does exist. But however, that's the angle they're taking. And they came out straight out the gate and said, look, this budget's going to raise £40 billion of taxes, and this is what we're going to do. So it came sort of from that angle. So we all knew there was going to be tax rises, and there were a few leaks in advance, so we could kind of have a feeling for what went on. Actually, I predicted one of them. There's only two things I've ever predicted in my life that came true. That's one was France winning the World Cup in 1998, I want to say. And this one was the other, and that was that I felt that the employer's national insurance was an easy target politically. And we're going to talk about that because that absolutely got hit. So they came out and they said, yep, this is what we're doing. We're going to need to raise taxes to do all this great investment in public services. You know, I think everyone would agree would need this investment. So that was what was happening, and that was the backdrop. They then said, okay, we want inflation. So, you know, that's where all our pricing comes up over time, you know, the cost of food and all the rest of it. And they want to see that at around 2%, which I think most governments have kind of aimed for that kind of era. Oddly, the actual document shows that it would probably rise and then drop back down is their prediction. But regardless, that's kind of where we're aiming for. So it's on that backdrop, but they also said, we don't want to see austerity. And it was interesting to what they did do. And in some cases, you could say it was relatively clever with the way it was done. But as with all the politicians and things like that, how they say things can seem quite positive, but when you dig into the detail, sometimes it's not. And certainly what we found, and the reason this video is slightly delayed, is I wanted to read all the docs in detail because a lot of things were missed out of the speech, and there's a lot of things hidden in the documents I'm going to talk here that weren't in that speech. So it's been a really odd budget in that sense. Politically, it was kind of, I suppose, well done because a lot of these things got missed off that could have been bigger, and I think over time will start to come out and be more of an issue than they are at the moment at the time of recording this video, literally the day after. So let's get into the actual main measures. So let's start off with the employer, the bad, I guess. If you're a small employer, what's happening is you currently, if you employ somebody, let's say you pay them 30K, You employ them, then you pay their pension on top. There's normally about 3% minimum. As that gets added, that's another cost you pay. And then you pay a national insurance bill on top. Currently, that's 13.8% when that person earns over around £9,100. What's been announced as changing is that percentage now goes to 15%, so that's 1.2% higher. But the biggest hit is the fact that that 9,100 threshold's been slashed to just 5,000, and that is really, really impactful. That's very expensive change for any employee, any employer on that employee's wages. So what's happening now is per employee, your costs have now got a lot higher. Now, what the government announced, which was good, but we'll talk about the impact of how much difference it actually makes, is they said that the employer's allowance, so most small employers get something called employer's allowance, and we've done another video on that, plenty of blogs and things, because it's often a missed opportunity, is it effectively says, look, the first £5,000 you get of employer's national insurance you have to pay on those wages, we're going to let you off. It's an allowance. Don't worry about it. That is being more than doubled to £10,500. Now, that's a great measure usually. I've been a big proponent for increasing that. I think as a small employer ourselves, not having to pay those extra costs on top of employees, really, the employees' general costs really do help to kind of, for you, encourage you to keep growing, keep creating jobs and things like that. So that is a welcome change. The problem is, in the backdrop of this increased cost, it doesn't actually do too much, and I can show you some examples of what that might look like in a small coffee shop example in a minute. So it does actually stop a lot of small employers paying the extra national insurance. But what also came along in the budget is they're massively hiking the minimum wages and the living wages. And whilst a lot of small employers don't necessarily pay the minimum, what it does is it has a knock-on effect up the chain. So if you imagine at the moment, what's going to happen is somebody over 21 is going to end up on £12.21 wages. That's quite a decent minimum wage, a living wage as it's known. Now, that's okay, but if you've got someone currently on £12.50, which would probably be about a poundish above what the current living wage is, because they've got more responsibility or they're a supervisor or something, there's a nice kind of difference and it's clear. What happens when they're now 29p away from the minimum? How does that make them feel? They may come and say, okay, look, I think I should be more appropriately paid then for my kind of job. And you could kind of see that viewpoint, surely. But that means you've got this knock-on effect up the chain of all the paid rises you have to do when you adjust all your bands because of it, or you end up with a bit of discontent, and it's just a mess, really. So, and that's always the problem when you have these forced wages upon you. Now, the minimum wages, even for apprentices and under 18s, has hiked. So you've got hikes there of up to 18% in some of those rates. They have massively jumped. So you imagine if you were a small cafe or any of these places that generally do pay, not always, but generally do pay minimum wages because they take on unskilled workers, teach them what to do and pay them appropriately, or at least appropriately from their point of view and how the business model could afford to do it. They've now got an 18% hike on some of those rates. But it isn't just 18%, because on top of there, you've also got your pension's now gone up. You're already paying 3%, and now that 3%'s more, and your employer's national insurance bill on the 18% rise is now more, and it's gone up. Okay, some of it will be relieved from the employer's allowance potentially. But what that meant in practice is that for a small employer, you would have something like, if you did, I did an example where you had 2 part-timers at 18 and a full-timer at over 21. That wage bill ended up being £3,400 more the day you change into the new tax year, a year. You've got to find £3,400 more somewhere in your business. And most small businesses can't absorb those kind of costs. I mean, for our business, it's a 35 grand a year problem. That's somebody's wages. You know, it's a real problem. And I think for the economy, that's going to have an impact, because small employers, who are about half of employers in the UK, will not be able to absorb these costs. So the only way it's going to happen is they're going to have to put it onto their prices. Therefore, everybody pays more, inflation goes up. I'm not an economist, but from what we see in the small business world, that is very likely to happen. And now, small businesses react slowly, and if you're a small business owner looking at this, I'm encouraging you to look at it now and plan for April, because I think you're going to have to make changes if you employ the team. It's just going to have to happen. You have to figure out how that looks in your business model. Don't leave it late, because what tends to happen is small businesses will leave it late. You'll get halfway through, say, middle to late next year, and realise you're running out of money, and what's going to happen? We're going to have to all change it. So start thinking about it now. So for small employers, it's a real problem. And if you're thinking, look, there's a lot of information that we're talking about here, Dan, I'll link a blog below that summarises a lot of these key points, so you can read it in your own time as well. But do know that one is a real problem for small employers, and I think that's where a lot of the chat we're already seeing online and in the media is around the impact that's going to have on people. So that's there. Now, if you're a working person, maybe you think that's great, my minimum wage has come up if you're on minimum wage, can completely see that. I'm just not sure in real terms how that's going to affect. Certainly, the Office of Budget Responsibility that oversee that budget have accounted for the fact they think it's going to cost in real term wages the UK working sort of population there about 7 billion a year in lost wage increases, because businesses will just not be able to afford these continued wage increases. We've just come out of a period sort of post-COVID of massive wage inflation, and now we're going in a period of forced wage inflation. So it's going to be a real challenge. So if you're a small employer, that's that. I know there's a bit of detail in there and it's a bit of a ramble, but it's really, really important to understand. So yeah, hopefully that's put you in the picture and go away and do some sums. Now, the other changes is a bit more bullet pointed, I suppose. There's a slightly less nuance to this, but the biggest one being from a personal tax point of view. If you're looking to sell something, so say you've got shares, crypto, something like that, you're going to pay more money now in capital gains tax. Those rates have gone up. And what they've done is, at the minute, if you sell a residential property that's not your own home most of the time, so like a buy-to-let that you're getting rid of, you're going to pay somewhere between 18 and 24% capital gains tax on it. And that only applied, though, those rates to residential property. Everything else was 10 or 18. So what they've done is they've aligned those rates. So now you are going to pay more. And recap from a while back, they already cut the amount of capital gains you could make tax-free substantially. It used to be over £12,000 a year you could make in the capital gains. Now you're down to like 3. So if you're looking to sell big stuff, you are going to be taxed more. But I think most people, I feel, and talking to owners and everything else, don't see this one too much as a problem, because they think, well, they're normally, for most people, they're not that regular events. So if you're going to do it, at least you can budget into it and it's fine. And if it helps fund our public services, maybe that's not a bad way of doing it, but it doesn't actually raise that much tax, but they are doing that. So the rates are the same. I mean, there's a simplification to that, because at least you think it doesn't matter if it's residential property or not, I'm still going to be paying the same amount of capital gains tax, but that's gone up. Now, where it might affect small business owners a bit more is when you come to sell your business, or sometimes not even sell it, when you come to close it down and maybe you liquidate it because there's quite a lot of cash in there, you could often claim, if you qualified, something called business asset disposal relief, or entrepreneurs relief as it's known, or used to be called, and that allowed you to get, for your first £1 million of gain, you'd be able to get that at 10%. Now they're changing the rates. They're not removing it, which I think people thought they might do, but they're changing the rates. It's going to go to 14% and then 18% the year after. So it's still going to be cheaper, but it's not going to be as attractive. So again, if you're selling your business, that's going to be something that's changing. The one piece of good news with that is that we have got till the 6th of April 25 to figure that out. So if you're selling your business this year or thinking about it, let's get it transacted before the end of the tax year, which isn't the case with some of these other reliefs and changes they did. For example, if you couldn't claim business asset disposal relief and you actually just sold your business naturally and you didn't qualify for whatever reasons, if you didn't get it closed before the end of the budget day, the 30th of October, you end up paying the new rates. So if your solicitor was on holiday because you couldn't get the transaction done, like for a lot of places it's half term, like I know locally around where we are, it was half term, so people were off. That could actually cost you, if it's a 10 grand deal, it could cost you £800 by not being able to transact it before the budget speech. So I'm disappointed to see that. I don't like the idea that you can't react to these things. I think it's okay, like it is with this business sale. If you can claim entrepreneurs relief and you've done a lot of planning, you've got time to make that decision. The fact now you can't do anything about it just feels really sad. You might have already priced the entire deal based on certain assumptions of tax and they go out the window. So that's happened. And the same thing that's also happened is if you're buying a second property, the stamp duty has jumped from an additional 3% to an additional 5%. And again, it's here. You can't do anything about it. There's no time limit on that as such. It's already here. So if you did a property before the speech, fine. If you did it the next day, you're paying the new rate. Now, another thing that's going to affect business owners is business rates. Now, as somebody who rents a relatively sized office, business rates, I know how much they hurt. They really hurt, because quite often in an office, you're paying for service charges, which already pay for all the facilities and the bins being emptied and the repairs and everything else. And you just pay this whacking great sum of money to the local government for whatever reason. And if you're a high street shop, that is so painful. High street shops really struggle. And they've had, if you're in the retail, hospitality or leisure industry, you've had a 75% discount for a long time. If you're in a small shop that's got what they call a rateable value under 15,000, you might actually pay no rates. So you had these two things. You had this kind of no rates people, and you had we've got a 75% discount people. So maybe like your larger pubs or something like that. Now, in the budget speech, it was kind of like, well, it was coming to an end and we're going to extend it, but they're only extending it to a 40% discount. So your business rates are actually going up if you didn't get the small business rate relief. And if you didn't get the small business rate relief and you weren't in the retail and hospitality sector, so you're an accountant, for example, then actually it's going to go up anyway, because they've said the multiplier, which is the thing that makes the bill what it is going to go up based on, I think, CPI or like an inflationary figure. So it's already going up. So if you're on the high street, not only have you got to deal with staffing challenges and costs, you've also got to deal with a business rate increase. And I'm very worried for our high streets, particularly in the small towns and places without a lot of footfall where it's already quite tough. So that's happening. I also think, side note, but a lot of people, landlords and people, commercial property owners, have had problems with their own mortgages massively rising over the last couple of years. And when it comes to rent review times, they're going to end up needing to pass those costs on. So the entire cost base of like your little shop on the high street is going to go really quite high and be a big challenge in terms of their own survivability and how they price their products. So TBC on that one. I'm sure we'll do more videos as that comes out. Now, moving on to other things. If you're in a limited company and you provide some cars to yourself or to any of your team, the rates always tend to go up. There's this thing called benefit in kind, and we've done other videos on it, but effectively, if you've got access to a company car, you get charged from a tax benefit of having that. And as a result, a lot of small businesses, say limited companies with one or two directors who are the owners, they might not actually even want to put their car in the company because it's too expensive. So that's very common. But electric vehicles has been something that's been very attractive. You know, they were like 1-2% benefit in kinds, which was a tiny amount of money. But the government have been slowly increasing those. And by the time we get to 2029, and this was buried in the back of the budget, you'll be at 9%. That's quite a chunky bill. So you've got to really make a decision about whether it's worth putting them in at the moment. But that's a long-term issue. But no, that's happening. And the other big change is something called a double cab pickup. Now, in the tax world, we all kind of know what a double cab pickup is, but I call them like monster trucks. Think of like, you see these commercial trucks where they've got 5 seats rather than 2. So you've got like a flatbed at the back and then a couple of people at the front, but you can also have like a bit on the back, this double cab. Now, they, for tax, have been pretty good because they've been really a van for tax purposes. So they've had really good allowances when you buy them in year one, and they're very cheap to have available to you. That's changing. They tried to change it early 2024 and everybody went in uproar about it. And there may be political reasons. I've heard various tinfoil hat reasons as to why they came back on it. But the day after they went, no, don't worry, we're not going to do that actually. You guys, we hear you, we're not going to do it. Buried in the bottom of the budget document, they've said from April, those double cab pickups are going to be cars. If you've got one in the business now, you don't need to panic initially because they're giving you to about 2029 to sort it out, but do know it's going to change. It certainly impacts buying decisions now. So bear that in mind. And if you're in the world of selling those things, it's also something to be concerned about the potential impact of how that might look. So yeah, double cab pickups are going back to being cars, or I should say, they're now becoming cars. And this is all based off a tax court judgment in Europe. Now, sticking on the limited company train, we did have some good news. I said there was some good news, and there was, and that's the corporate tax roadmap was published. It's something Labour have said they were going to publish since the beginning. They would lay out what we're going to do because businesses need stability. I don't want to be coming on here and telling you that something's really cool one day and then 6 months later it's not because they've changed it. And what they've done is in their manifesto, they said we're not going to increase the top rate of corporation tax. So that was set, and it's a relatively new change. It was set at 25%. So people are now seeing that increase in their limited companies and now having to start paying those bills for the first time. But below that, they also had a rate where your first £50,000 profit was taxed at 19%. And then the bit between 19 and 250,000 was kind of what they call a marginal rate. It was a bit of a sliding scale before you eventually reached 25%. The maths of it didn't always work out like that, but that's how it's generally portrayed. Now, what would happen is they said in the manifesto, we're not going to change the 25%. They didn't say anything about removing the bottom end. So I was very fearful they may, a bit like they've done with the employer's national insurance, they haven't technically moved the main taxes up. They've just bunged it somewhere else. This one, they haven't. They've said in black and white, we are keeping those two middle, like smaller rates under the 25%, which is really good news and hopefully provides some stability for planning in your corporation tax world, in your limited company. At least you know what your tax bill is going to be presuming they don't suddenly backtrack on these things. So that was one piece of good news, is you've got some stability there for your corporation tax. Now, inheritance tax is making headlines as we're speaking because there's some issues with very expensive farms. I'm not going to talk about that in here, but I suspect that'll end up getting looked at. But currently there's a bit of a problem. There's also some changes to whether your pension's now going to be included or not. And where inheritance tax is something that I don't particularly advise on or get excited about, I'm not going to go too deep into that, but know that if you're looking at estate planning, that's often done with a combination of an accountant and a financial advisor, there's definitely some things to be talking about around this time. But there were some changes, and they've also frozen the threshold at which you start paying inheritance tax. So I think a lot of people presumed there'd be this raid on inheritance tax and it would get really expensive, and they changed the rate and lower the threshold. They didn't do any of that. They've just sort of trimmed it around the edges about what isn't in and things like that. So have a look if that's of interest to you. Do have a look, because I don't think there's any good news there, but it's not disastrous for a lot of people outside maybe the farmers. So have a look if you're in that world and you're thinking about your inheritance tax. Chat to your financial advisor about that. Now, HMRC, interesting one. It's not a tax particularly, but what they are doing is they're increasing the interest rate on late paid tax. So one of the things that is very much a reality at the moment is if you've got a struggling company and it's do you pay your suppliers or your team or HMRC or your other lenders, the general thing tends to happen is you don't pay HMRC because they've got the lowest interest rate and they're not very strong at collecting money. That is changing slightly in two measures. One, the interest rate's going up at 1.25%, so it's going to be more expensive. It's still relatively low, but it's going to hurt if you owe tax. I don't necessarily think it's a bad thing to encourage people to actually pay those taxes, but that is coming in. The other thing is they're actually employing another 1,800 staff, it was buried in the document, to say that they're going to work in the debt collection office, so they're going to be trying to actively collect this debt more appropriately. And we saw that back in the financial crisis in like 2009-10, they did that, got really hard all of a sudden on collecting money. So maybe we see a return to that. And they also said, as part of all this funding, that the revenue are getting another 5,000 staff being recruited for compliance. Because one of the things we have is, yes, they do investigate things, but honestly, they don't get to, I think, anywhere near enough of looking at people's tax returns, because I quite frequently talk to people both online and in person. I'm like, that's not right. You should not be doing that. And they'll say, but no one's ever said it's not. And that is a concern for the industry and everybody else who's appropriately paying their proper tax. So having some more compliance staff, I think, is generally a good idea to hopefully crack down on some of the bad acting, as long as they're appropriately trained. So that's going to be good. So we've got that coming on. I think it depends how you view it. You might not view it as good because nobody wants to be investigated by the revenue, but having a bit more control and maybe a bit more of a fear factor for people to get this right might actually be a good thing for collecting taxes, and maybe you won't need to collect as much. There's a hope. So that's happening. And talking of bad actors, you might have heard the term umbrella company. Now that generally happens. It's like you're a pseudo employee. So it used to be back in the day when it was okay. Agencies used to place one person limited companies. So you're an IT consultant, a one person limited company into a company that needed their support for a fixed period of time, and everybody was happy with that. The government changed the laws, and at least their interpretation and some of the laws about how they reacted and dealt with something called IR35. You might have heard this. It's a big topic. Hobby Horse of Mine, there's a book behind me, and it's not a great piece of legislation. It's never really been fit for purpose, but it effectively shut a lot of this down, and it pushed people into being pseudo employees in an umbrella company. An umbrella company is like your employer, but they start taking everything off of you that it costs them. So it's a really weird thing. And on top of that, there's a lot of bad actors in the industry. So they're looking to continue to regulate that. In an ideal world, I'd love to see that all shut down, but it does kind of solve a purpose in the industry where we have this problem where you do have these genuine freelancers, but because of the laws, can't really freelance. So they're sort of stuck in this weird place, but hopefully the regulation around that makes it at least a bit fairer. So that's happening as well. And I'm sure most people listening to this aren't in this area, but there is something called a non-dom status. A lot of the time it's used by relatively wealthy individuals to rearrange their tax affairs. I'm not going to go too much into this, but it's been a big political thing. They're binning it still. So if you're in that, do speak to your advisors, because there's a few options you can do, but there's definitely something you're going to have to look at because it's going to be relatively impactful for you. And whilst there was a ton of other stuff in the budget, I think they're the key points right now. I think I may even break these down into some more digestible videos and look a bit deep dive into some of these things and how they're going to affect you. But for now, hopefully that puts you in the picture of the majority of things that are really going to affect you as an owner. So as we said, bit summary, as a limited company, there's some really good stuff from just a stability point of view, which is good. If you're a self-employed individual, there's not actually much change and you're still benefiting from lower national insurance. So you're kind of not affected currently in any real sense. I'm sure maybe after this video we dig in, maybe there's something buried, but I haven't seen it yet. And it's small employers that are really going to be the challenge moving forward. I think if the one place it will affect limited company owners, and your accountant I'm sure will be talking to you as we come around towards the end of the tax year, is a lot of spreadsheeting is going on at the moment to try and figure out, well, what's better, salary, dividends, what level of salary, because it's all thrown up in the air now, and that'd be really interesting to try to kind of, at least interesting from our point of view, try and math that out and figure out what's best. So that will be a change to you. I think there might be a world where you have to start handing over some regular national insurance to the revenue, but it's going to be still better in the tax sort of overall tax position and effectiveness for your tax efficiency. Can't even get the words out. So, but keep an eye on that more as that comes. I'm sure we'll have a video talking about the best way to pay yourself in 25, 26. So there we go. So that's it for now. Please do share this video with anybody that needs to know this information. I'd love to hear your experiences and your viewpoints in the comments below, and I'll see you in the next one.